G'day and welcome to this week's video. This week I'm going to reflect on a quick discussion I had with a friend of mine in Melbourne regarding disposable income and what they do with their funds. Now, we were at a financial advisor. It was a investment training day, and the comment he had was that all his mates and his peer group with their disposable income, all they do is buy assets that go down, as opposing to investing into assets that go up. So, and as you can see probably in this slide here that we can bring up now, that assets that go down can be obviously a car, boats, anything, Xboxes or whatever it is. Now over time they just go down really, really quickly, as opposed to other assets such as businesses, whether that's on the share market or, as the slide says here, a business that's selling boats or a franchise of some type, that if you can increase your revenues and therefore your profit, the value of that asset will go up. And I think we've got numerous really high quality investment businesses out there that we've invested in over many years, whether it's Google or Facebook, CSL. There's any number of really high quality businesses that we invest into. Their value goes up over time. But when it comes to consumers, spending dollars, we'll see that on something that has no income value to it. If it's not providing income to you, it's going to generally go down in value over time. So just this quick slide I thought was interesting, looking at a $30,000 vehicle, a brand new vehicle. We've always known that as soon as you drive it out the showroom, you lose a certain amount of value day one. That is absolutely true, but you can see here that obviously depending on what type of vehicle you buy, some depreciate faster than the others, but at the end of the day they all depreciate very quickly. And one thing that a lot of clients ask me, that should you get to year 3 and turn your cars over and so you keep value there. Of course it's a personal approach that everyone can take. Some people like to have the latest and greatest, and from a safety point of view I think that's really important. But if you get to a $30,000 car, and say the mid-range point here at year 4 is you've lost half your money, if you had it for another 4 years in percentage terms, you really haven't lost that much more. You do most of your dough at the early point in terms of a purchase. But when it comes to obviously clothes and electronics and the like, they depreciate much faster than this. And as my wife has experienced recently, when she's tried to sell some second-hand clothes that some of them have barely been worn, people really don't want to pay you anything for them at all. So clothes and electronics really don't hold too much value, except for the odd iPhone. So by contrast, looking at this is Peter Thornhill's graph that he's used for many years. So the red line here is a $100,000 term deposit, and it's comparing share investment compared to a term deposit. So we're not really comparing term deposits, it's more so around appreciating assets compared to depreciating assets that go up compared to assets that go down. So you can see $100,000 invested in 79 to 2015. You can see here that the dividends are the bars here. So in 2015, that $100,000 is now bringing in $80,000 per year, and the capital value is this point here, which is around $1.8 million. So you want assets that can grow over time, and obviously Warren Buffett says there's an amazing amount of really high quality quotes. So you've really got to find a way to make money while you sleep, otherwise you're going to be working till you die. So he's talking about passive income, where you're investing into, say, the share market, and it's growing over time and providing you income, and income that can grow. Now, of course, I'm talking about having a balance here. It's not being miserable and forever investing. It's about getting a balance in life. I think that's really important, but we've got to be doing a bit of both, enjoying ourselves now while putting some aside for later on. So, thank you for listening. I hope it was of value. Please subscribe to the channel if you'd like. That'd be great, or give us a thumbs up, and we'll catch you next week. Thanks for listening.